morning, ladies and gentlemen. A very warm and a very fantastic welcome on Business Today Television on this very fine Monday morning, where you have gains and record highs all across Dalal Street. The reasons are fairly simple to guess. It's a confluence of three major events. Prime Minister Modi, from the ramparts of Red Fort, announced a Independence Day bonanza for the Indian middle class by saying that in the next 2 months GST rates will be slashed for about a vast percentage of products of mass consumption at Indian households. Taxes will be folded into 15 and 12% slabs from the 4-5 slabs earlier. That will lead in a reduction of household expenses. It will lead into price ticket items like two-wheelers, cars, ACs, cement being cheaper, and that's the reason, ladies and gentlemen, you have a blowout on Dalal Street. Take a look at the Nifty. It opened 340 points higher on the Nifty as far as markets are concerned on Tuesday. This gap up has taken the index well above the 21-day exponential moving average, and in a span of just 1 weekend, you are now at the highest since July 25. This is not the only good news. The other good news is the ratings upgrade that happened by S&P as far as India is concerned. For the first time in 18 years, the BBB rating by S&P is now the highest in 35 years, and that means that Indian bond yields will move down. Companies such as Bajaj Finance, HDFC Finance, who seek money overseas, will pay lower borrowing costs to the extent of 15 to 20%, and a lot of FPI money will come into India via the debt route. So there is no surprise that Bajaj Finance is up 5.3% at 910 rupees. Look at Maruti. This has been the top draw. This is India's largest maker of small cars, at a record high today, gap up opening, and after a gap up, it's up 8% at 13,959. You have similar moves coming into Hero Motors. Many auto stocks today are at all-time highs as far as prices are concerned. Hyundai, which is the rival of Maruti, is 9% higher at 2,441. TVS Motors is at a record high 3,247. Two-wheeler sales ahead of Diwali, and more importantly, there has been a great monsoon this time, so rural incomes will also go up, and that's the reason, ladies and gentlemen, you have two-wheeler stocks like TVS Motors, rural plays such as Mahindra and Mahindra at record highs. Mahindra and Mahindra 3421. Remember Thar, remember Bolero, remember Scorpio. These are 4 SUVs that are the backbone of rural states like Haryana, Rajasthan, Uttar Pradesh, and with incomes rising and their GST costs going down. Remember, all 4-wheelers and 2-wheelers are at 28%. Most likely they will come down to 18% as far as GST is concerned, and that's the reason, ladies and gentlemen, you see this mad rally for auto stocks today. Look at Ultratech Cement, 4% higher, 12,850. Cement is also taxed at 28% GST. Most likely it will be brought down to 12%. So these are the kind of changes that are likely to happen. Look at all FMCG stocks. Because household incomes will rise, that's the reason why you see the Nifty FMCG index having a lot of gains. Hindustan Unilever is up 3.4%, 2573. Look at Britannia, 3.8% higher. Colgate Palmolive, 3% higher. These are all stocks which are in the FMCG basket, and rising household incomes are more likely to see a smart gain as far as these changes are concerned. Look at stocks such as a smart move that is coming into companies such as Ashok Leyland. Look at AC makers. Amber Enterprises, 7.5% higher. ACs are also taxed at 28% GST. They are likely to be brought down to 18%. Remember, this time summer was cool, therefore you did not see great sales of air conditioners. Look at Voltas, 8% higher. Fridges will also be cheaper, 1372. Look at how changes are happening on campus footwear, 4.5% higher, 265. Look at Bikaji Foods, 6.6% higher at 770. Whirlpool, the maker of fridges, brown goods such as microwaves, as also washing machines, up 5% at 1301. So a savings in taxes plus the income tax benefit that had happened in the budget, all put together will spark a rally in broader markets and also boost consumption. Remember, half two, which is the second half of India's financial year, is always traditionally better than the first half because you have a string of festivals. And that's the reason, ladies and gentlemen, you see this very, very sharp rally that has happened in the Indian market today. Amongst the indices, you have a top gain in the Nifty Auto Index. No surprise there at all. 4.5% higher on the Nifty Auto Index at 25,321. Remember, the first 1 hour of trade, 2 hours of trade has lapsed and the gains have held. So today the Nifty will have a trending day. A trending day is when the Nifty opens gap up, and from the gap up it continues to rise slowly but surely throughout the day and ends at the day's high at 3:30 p.m. This is most likely to happen today because this is the start of a fresh rally in Indian markets based on three major events: GST cut, the upgrade of Indian ratings by S&P, and of course the punitive tariff that was supposed to come in, the extra 25% from the US, that is not likely to take place. This is what US President Donald Trump has said over the weekend. So a very fruitful 3 days in which the markets were shut: Friday, Saturday, Sunday. Friday because of Independence Day, Mr. Modi made the announcement from the ramparts of the Red Fort about the GST rate cut, and he also said, ladies and gentlemen, buy local. Buy your local brand when you want to gift. And that's the reason why you see a lot of domestic companies. Look at Patanjali, how it is rising. Patanjali is also up 4.5% today. But brown goods makers, Amber Industries, Voltas, Blue Star, and of course companies such as Dixon Technologies, all of them are showing smart gains because you will see a demand coming in for all sorts of brown goods like fridges, air conditioners, washing machine and microwaves. Auto stocks, because a good monsoon plus a cut in the GST will fuel supply and demand for Hero Motors Splendor, Aisha Motors Bullet, TVS Motors Samurai, and of course four-wheelers, also commercial vehicles, because they will also see a rate cut from 28 to 18. That's why you see Ashok Leyland doing very well. If you look at the Nifty Auto Index, ladies and gentlemen, the gains are dramatic. Look at Ashok Leyland, 7% higher. Look at MRF, 3.8% higher. And look at how auto ancillaries have also gone up sharply. Look at how Gabriel, shocker maker, has moved up. At the moment, it's up 8% to a fresh high, 1164. Endurance Technologies is also an auto ancillary maker, which is 11% higher at 2887. Now, this is the right time, ladies and gentlemen, to introduce to you a very, very intelligent guest. Mr. Jyotivardhan Jaipuria, founder and MD at Valentis Advisors, joins us. Mr. Jaipuria is a past master at tracking Dalal Street, and over the last 30 years has made tons of money for his clients and unit holders. A very warm welcome to you, Jyoti ji. What a day to have you. You know, I don't know whether this is all good luck or very strong effort on the part of our guest team to get Mr. Jaipuria on the day it matters. How do you feel about this new rally on Dalal Street?
Yeah, good day to come. So maybe, I should come more often here to get the markets moving. But so over the weekend, I guess we got really positive news, right? Uh, One is obviously the GST announcement, which somewhere has been talked about for a long time, but then we were not expecting it to happen like over the 3-day weekend. So that was, I think, the real big positive news. Apart from that, of course, the Alaska summit, I don't know whether it went well or not, but tonight is where I think a lot of discussions will happen around it. So maybe, there will not be as much optimism after today's meeting on that war front at least. But things are looking positive. We got the S&P upgrade also for India, which is another positive we've seen.
Yes. Okay. And just as you come in, Mr. Jaipuria, Maruti has closed 14,000 rupees. It's happened for the first time. Fresh record high, booming volume. 1600 crores worth of Maruti has been traded. Ditto for Hero Motors, 1300 crores traded. Given the background that we've seen in GST and the last 1 year that has seen Indian markets flat, what are the changes that you expect to make in your own portfolio with this background? One, a cut in GST, and of course, no punitive tariffs coming in.
Yes, Shell, I'll just tell you these punitive tariffs are still not a done deal. Because if you see,
J,
the whole
J.
state delegation which was to come,
Okay.
they postponed their meeting. And, Trump has been, it won't come, but it can come. So I think it depends on how the course of negotiations go, from what, and this is all media. So basically, generally, the Russian angle has been to give us this much territory and then we'll stop fighting. From whatever the media says, I don't think Ukraine is ready to give that territory. So maybe, after a few days, we'll get little less optimism on it. But we have to keep our fingers crossed and hope that at least for some time we don't have those punitive measures coming and India and US start talking again. Otherwise, maybe a week later, 10 days later, we find that actually the tariffs are getting implemented on us. And then, we get a little more pessimistic on it. The GSTs where, which is in our hand, because, a lot of this is not in our hand. The GST is in our hand and the GST is like a great measure. Now, exactly how it plays out is still in the air, right? Because today we are taking the optimistic scenario that everything which is 28, we are assuming will go down to 18. It may not happen because already there's some chatter that in cars, what they'll do is link it to the engine size and all. But hopefully there'll be positivity coming out from it. There'll be at least some sectors which will gain. Cement may be one of them, and a lot of consumer goods may be the other. The cars and the two-wheelers, I think, at least on two-wheelers, we should see reduction. I'm not sure whether it's across the board for cars or it is only for some cars, and they'll exclude the luxury cars. So we'll see that coming.
Yes, sir.
It will probably take, I think, a few weeks, maybe 5, 6 weeks before we get clear on who's exactly gaining and losing from this. The other thing is interim, what it may mean is slower sales or some of these items which are like long duration. So, for example, white goods or cars. Till that GST cut comes, now the incentive for the buyer will be I can postpone my decision for the next, 6, 8 weeks. I should wait because I may get like, 10% cheaper or the 7, 8% cheaper car. So, you see interim sales starting to slow down. And, in autos, that has been one of the concerns before this thing came that
Okay.
auto sales were clearly slowing down. So, to that extent, that slowdown may get a little more painful. The dealers will not want to stock because suddenly they may get hit with a lower price. So manufacturer may have to give some incentive or you may see incentives coming that you buy today and we'll give you a discount which will disappear once the GST comes. So some of these are things which will play out. It's not like all clear, but the direction is clearly positive that the government is trying from their side to address the problem and give some. One is make taxation easier, which is what the two levels of taxation on GST from the existing five will do. And the second is they're trying to give some sort of stimulus because they know that the economy is slow And probably the trade deal with US or the lack of trade deal with US means that we are going to have a bit of slowdown on the export.
Mr. Jaipuria, the issue I think with the market as also with the industry was that not only do we have punitive taxation, there is also this throttling of business. Now, whether this issue with the US has resulted in the government opening his eyes to the reality, or maybe this was the time when these things were to be done, only time will tell. But the fact is that this is a kicker that the markets needed after maybe 11 months of intense pain. I mean, if you look at September to September, we are still flat, and we've lost about 12 months. Meanwhile, earnings have also improved for the better, at least from what they were earlier. So, how do you feel as far as sentiment is concerned on Dalal Street? Are you now looking forward to quality stock picking?
Yeah, so like for the change, and in India, the worry always used to be we have great companies, we have great micros, but awful macros. For the change, what we are seeing is great macro. But we have, awful micros in the sense earnings are not growing.
Yes,
If you see like our
correct.
current account deficit, fiscal deficit, they're in good shape. You look at, inflation, like we are running way below US inflation, and that is giving room for easy liquidity policy, that's giving room for the interest rate cuts. So, if you step back and think of macro is looking good, even when you look at GDP growth, we're still the fastest growing economy in the world. So you may think we're not growing as fast as we want, but we're still the fastest growing. The problem comes when, earnings are not growing and, even this quarterly season has just got over. To my mind, it probably did a little better than the lower expectations of the analysts. Analysts had brought down the expectation quite a bit. It probably on the margin was a little better, so we'll say flattish to slightly better than analyst estimates. But it's still like single digit growth. So in India, single digit growth is not exciting, right? You're going below nominal GDP growth. So, it's the earnings which have been a problem, and that's been the reason that the market has not really done well. Like you said, we are flattish on the large cap. We're actually negative on the small and mid cap. And that's because of this earnings pain which is coming. Our view is that the earnings probably slowly recover over the next 2 quarters, and that probably should help markets start giving a return. Valuations are not cheap enough. So, at some point, valuations will probably trade a little lower than where we are today. And the only thing which is holding up valuations are the strong macros which we've had, which mean that people are saying, okay, that's an economy which at lower levels we want to buy.
Correct. I think that's very well said. The strong macro coupled with 25, 27,000 crores worth of SIPs is what is helping the Sensex and Nifty remain afloat. I think there was also this wonderful news coming in that India is now ranked 10th in terms of market capitalization. Prices have corrected for the better and for good stock pickers such as you. So while domestics remain a focus, Mr. Jaipuria, in terms of sectors, if you can elaborate, what is your ब्रेन थिंकिंग, कहाँ पैसे डाले जाएं जो नए आ रहे हैं, क्या बात की जाए कंपनी से. आई एम श्योर डिस्पाइट डिस्फिल Q1 you still have a lot of winners coming out in these quarterly earnings that we just bade goodbye to.
Yeah, so it's like in times like these, see, liquidity is easy, interest rates are down. So to that extent, what this is providing us is room is, you can do more work and buy stocks where you see growth being mispriced by the market. So for us, there are a lot of companies where we think growth will come back. For example, if we look at our whole universe or look at our portfolio, we're expecting earnings growth to be 20% plus for this fiscal year. And they trade at a valuation of 16 times. So
Okay.
what we try to do is find companies which are growing faster than the market and who are trading at valuations which are lower than the market on a very overall basis in our portfolio. So there are pockets to look at, and it probably becomes more interesting for people like us because, when this growth is aplenty and everything's running up in momentum, we somewhere tend to lag because we are like a bit of contrarian, I would say. our whole philosophy is the three U's, where we buy undervalued stocks which are probably underowned, underperforming. And so, we tend to not go in line with the momentum, but against momentum. So where we've been nibbling is, one area we've been looking at is like the cement. And that was before this GST news came, it's not linked to GST. But two, three reasons. One is, as the monsoons get over, demand scenario is quite strong. Second is the whole industry's got consolidated quite a bit. So what we will see in the industry is basically, because of the consolidation, pricing power will pick up. If you see the last 18 months, pricing was very weak in cement because, there are a couple of big players trying to gobble up some of the smaller players. But now that the consolidation has reached a stage where a lot of the smaller players have been, bought out, I think pricing power will come back to the industry. So that is one area where, we are quite positive on and we think things will improve. The other has been banks for us. We like the banks. They have NIM pressure just now. They have like, earnings are under pressure. But 2 quarters later, just like, NIMs came down because, the loans were getting repriced down and the deposits were not getting repriced. 2 quarters later, you'll have the lead lag effect of it, where, the loans have already got repriced and then the deposits start to get repriced down. So NIMs will pick up. So for us, it is, at sensible valuations, we buy things like this. Then there are some things which, I call them auto ancillaries and, real estate ancillaries, which are basically ancillaries to consumer demand. So, we have some companies which are into auto ancillaries, which are doing very well. We have some, companies which are ancillaries to the real estate space. For example, cables and tiles and wires and companies like that. And those are sectors which we find very interesting and where growth is there.
Okay. Uh, so you mentioned obliquely that smalls and mids are still way below what they were at the highs of uh, September 2024. When you set in fresh inflows, where is your bias at this point of time? Are you rooting for large caps, or are you still hoping that small and mid caps would come back in flavor? I essentially wanted to know, where is fresh money going into, large caps, or are you buying at lower levels what you already had in your portfolio?
Yeah, so if we like just step back to the beginning of this year in January, our view was very easy that the small caps will not do as well. Like our view was one is this year we're not going to get a great return. So ours was on the large cap, we get probably single digit returns for the year. And it looks like so far it looked like we're heading to that direction only. And second, it was that the small and mid cap will underperform the large. Now, when you ask me, I'm getting more neutral between small mid cap and large cap. The consensus is very, very clear in favor of large cap. So that is what is getting us a bit more in favor that, okay, a lot of the
Okay.
pain that happened. If you see January and February, those were the 2 months where the small cap was on a lot of pain. Like, the small cap fell like 20 plus percent and the mid caps also fell down. Since then, we've seen some recovery. Going forward, I think, we have a situation where liquidity is easy, and I don't think liquidity is going to get tight very, very soon. And that is generally good for small cap earnings. And so, that is one reason I think over the next 3 years, if I have to look at it, the small cap earnings will be much faster than the large cap earnings. And because of that, I think that over the 3 year period, small caps will do better. Uh, be neutralish now because I'm hoping you to get a bit more underperformance in small cap before the valuations become very, very compelling also. At the moment, valuation is slightly in neutralish zone when you compare to the small and large cap. And if we get some more underperformance, then it will really provide room for small cap to do substantially better than large cap over the next few years.
Okay. One interesting thing you mentioned in the early part of the conversation was how India's overall macro has only got better and better. So, with this ratings upgrade plus rate cut that happened on the side of RBI, is this macro looking good, much better?
Yeah, so the macro looking much better, and the rating cut was actually a rating upgrade, was more a function of the macro looking better already because they look at the same numbers that you and me and all of us look at. And to that extent, the improvement in macro has been helping our rating upgrade. So that, is something which we are seeing already. I think the plus for us, if you think about it, like for example, on the current account deficit, one of our largest item or their largest item is oil. And if you think of oil from now for the next 3, 4 years, probably oil prices, given where renewable energy is coming, you may see some pressure on oil, and oil probably goes down rather than goes up in the next few years. Second is India's oil intensity starts to go down because more and more we, have EVs coming in, and, so petrol demand starts to go down. So to that extent, one of your largest import item, which has been, like I would say, your weakness over all these years, probably that item will go down in terms of, the weight in the whole basket. So if I think of next 3 years, we are probably more positive on the current account deficit than we were. Same way, like if you just think of inflation and you think of what RBI had done, they manage it very, very well.
Absolutely. So, inflation at an 8-year low, record forex reserves, maybe the rupee dollar will improve for the better. And of course, reduction in borrowing costs for overseas buyers because of this ratings upgrade. All put together present a good rosy picture. At this stage, Mr. Jaipuria, what about traditional sectors like private sector banks, PSU banks, maybe pharma as well, which were the the sectors that kept the Nifty afloat over the last maybe 10 odd months. Will money seep out of pharma?
So see, the farmers are a bit more. So we like pharma. In fact, we love pharma, and we still have pharma in our portfolios. Uh, the only problem for pharma in the last few months has been Trump and his tariffs, because he's threatened tariffs on pharma. He's somewhere said it will be 200%, 250%, but
Yes.
he's not yet put it. So, just now everybody living with uncertainty on what is the extent of tariffs he's putting. If it is like 200%, then there's no sector which can absorb that sort of tariff. I am quite skeptical that he'll do 200
Correct.
because today the extent of problem they'll have on sourcing generic then will create a disruption in the US itself. But it's possible that what he does is he puts a smaller tariff initially and says 2 years later or 3 years later, this will progressively go up to 150, 200, 300 because I want manufacturing to come back to the US. In which case it becomes that the short term gets very clear, the long term remains uncertain, and we probably see some move up in the pharma stocks. So it's a sector which I think partly has just been moving around and not done well only because of the tariff situation. The faster he clears the tariff, the easier it is because I think he said it will come in the next few weeks. But if we get that clarity, then it gets easy to model in that, okay, this is the sort of hit these companies will take. So this is the sort of valuation they're trading at, and then we like it or we don't like it at this stage. So that's become the problem. This whole uncertainty on tariff has been, hurting the sector.
Okay. Sir, what about defense? The reason why I ask is that you are not a momentum chaser. You only look at stocks that have been beaten down, have, secular earnings as well as profit growth, large order books, all of which defense checks all the boxes. Now, at these prices, are they attractive to you? Or are you still looking at God being kind to you and maybe, another 10-15% down from here and then you start buying?
So, valuation wise, defense is not looking good. So, there are two things to it. The valuations are very high, so they are,
Okay.
building in next 2, 3 years of growth. The second is, there's most of the time there's like a single buyer, one buyer. There's a lot of weight in concentration in your sales. So if that buyer postpones the purchases, your earnings start to get very, very uncertain. So, that's the problem that what you're paying is a very, very high price with giving very little room for any error. So margin of safety is very, very low. It's a sector which I think will do well over the next few years, but at these valuations, we are not, willing to buy at these prices. So maybe if we get something lower, we'll be looking at it.
Okay. Uh, are you still avoiding FMCG?
Yeah, so for us, FMCG per se, just pure FMCG, the issue's been like the valuations. That the valuations are very high, and they've traditionally traded at very, very high valuations, but it's a category which is now very well penetrated. So, the growth in that category is not going to be very, very sharp. And for that lower growth, the valuations we are paying are very high. Because even like, you may get a one-off 1 year where the growth is high, but if you think of a consumer, if his income goes up or if prices come down, most of them are not buying the staples now. They'll probably buy more the white goods than the staples. So, the white goods is where you probably have a greater room for growth because the penetration is low rather than the staples where the penetration is fairly high.
Okay, okay, fair point. And my final question to you, sir, is outlook on precious metals. Given what Mr. Trump is doing, given what Putin refuses to do, which is a ceasefire, as also maybe a peace talk, which might see Ukraine settling down. Your view on gold and silver?
So see, it's like I don't track it as closely as probably stocks, but in general, gold will do well partly because of just the high dollar debt which is there. And so there'll be like a lack of faith there'll be a lot of talk on de-dollarization. Now, one alternative is there's no de-dollarization because there's no other currency which can take its place. But in general, everybody will feel like putting some more money into, probably precious metal like gold rather than have it in dollar. So I think a very secular trend is going to be that we'll see more and more central banks having a greater percentage of gold in the reserve portfolio than they've been having in the past. Having said that, we've seen a very, very sharp rally in gold. And so from here, I don't know, but any positive news in the world could mean that there's a correction which comes in gold. So probably something which, you want to look at over the next 3 years, 5 years, but you want to wait for some pullback before you really take any meaningful position there.
Okay. And will this pain in domestic IT continue? This is the only sector, sir, which is showing no signs of maybe turning around. Even today, the index is down 0.5%. What ails IT? Are you buying these painful valuations?
So, we are not. And the short answer, we are not is basically it's not, the
Okay.
short term we are worried about, but it's just for us, it is over next 3 years, 5 years. IT is going to struggle in terms of the business model. That as AI becomes more and more prominent, it's like, growth will be a major problem for these people. And what you may see is hiring going to slow down and, revenues not really going up. So for us, that was the call that it's a sector which is no longer what it used to be. So if it's going to be like a more stagnant sort of sector, then it may not be interesting. There are a lot of free cash flows. At some point, there may be temptation to buy it because short-term cash is there. But in general, we are avoiding IT because we're worried on the longer-term growth prospects of IT.
Fair point, Mr. Jaipuria. As always, it's hard work and a lot of perspiration and stock picking that will deliver returns for 2025. But the government has done its bit in terms of providing tax relief via income tax cuts, via rate cuts, and of course now by reducing GST. It is corporate sector that needs to pick up the baton and take forward Q2, Q3, and Q4 from here on. Thank you so much for your time. As
Thanks
always,
a lot,
it's
Shel.
such a pleasure listening to you.
Bye.
That, ladies and gentlemen, was Mr. Jyotivardhan Jaipuria, the CEO and founder of Valentis Advisors. He spoke to us on GST rate cuts, improving macro, cement looking good, staying away from defense and IT, and of course, looking forward to quality earnings from corporate India. Thank you for watching.
Well, the Mercedes CLE 53 is here with us. The eighth launch